Good morning and welcome to Charting the Markets on Monday, the 4th of September 2023. Now, with today's US Labor Day, equity markets and other markets are probably going to be quite trading in low volatility over the course of this day. And we haven't really got much on the economic calendar anyway, except for the Bundesbank President Joachim Nagel speaking at 2 o'clock and also the European Central Bank President Christine Lagarde speaking at 2:30 p.m. So let's perhaps summarize what happened last week. And we saw a cooling of the US labor market. And basically, market participants interpreted that as the Fed no longer hiking its rates going forward. And this led then to risk-on sentiment in equities rising and closing for the second consecutive week in positive territory. What we also saw is in Europe growth slowing and inflation remaining sticky. So this actually is pointing towards the Eurozone, at least, perhaps being in stagflation, which obviously wouldn't be very good for equity markets. But at the moment, they seem to shed this off as they focus on China. And what we've seen in China over the last few days is lots of different stimulus packages. And the latest one we're waiting for now is one to do with property markets and removing restrictions in some of the larger towns to for providing property to prop up China's property market, which obviously has a huge impact on China's economy. And we'll have to see how that impacts financial markets. But basically, on that news earlier this morning, we had Asian markets rallying quite strongly, and this is filtered through to the European session as well. And as we can see here on the daily financial bet of the FTSE 100, we can see that we have risen above last week's high at 7,510 and are now on track to head back up again towards the early July high at 7,562. So that's my next technical upside target, ahead of the high seen on the 10th of August at 7,624, and also the red line here, the 200-day simple moving average, which is my ultimate target for this chart at 7,640. So further upside is in store for the FTSE 100, as we can see here, and this view will remain technically valid provided we stay above the last reaction low, and that reaction low was made on Thursday when we had a low at 7,419. So provided we stay above that level, further upside is in store for the FTSE 100 as this risk-on sentiment seems to prevail, even though we have now entered the month of September, which historically speaking, going back to the 1960s, is actually most of the time a negative month. But we'll see what happens. I mean, at the beginning of this month, it does look positive, so at the moment. Now, with the US session closed for today's Labor Day, I thought we might have a look at European markets instead. And first of all, let's have a look at the DAX 40 contract. As you can see here, we traded sideways over the last 4 trading days. And this morning basically recovered and went straight up to the orange line here, the 55-day simply moving average at 15,948. And above here, we also have last week's high at 16,044. which needs to be exceeded for us to be heading back up again towards the June and July highs between 16,187 and 211. And these, for me, are the upside targets short term over the next few weeks for the DAX 40 contract. And again, here, what we need to do is hold on a daily chart closing basis above the last reaction low. A reaction low is simply a low which is made on the daily candlestick chart or bar chart, if you want, which is lower than the one to the left and to the right of it. So in this case, Friday's low at 15,824. Provided we stay above there, further upside looks to be more likely than any downside momentum. And if you look at France, and you can see here the French CAC 40 is in a similar situation in that it has consolidated over the last 3 trading days, but has held above the orange line here, the 55-day simply moving average at 7,308. And has risen this morning and is heading up again towards the August to September downtrend line, which comes in at 7,390, and also is heading back up again towards the late August high at 7,407. Now, this is the high that needs to be taken out for us to be heading back up again towards the 10th of August high at 7,465, ahead of the July high at 7,526. But as you can see here, we are building upside momentum, and provided we stay above Friday's low, in this case here at 7,286, further upside looks to be in store for the CAC 40 as well. Now, FX markets have traded around the dollar over the last few weeks, and the US dollar index has actually risen for several consecutive weeks now. And we can see the inverse of this on the euro. If you look at euro dollar, you can see here that the euro, which makes up 57.6% of the US dollar basket, has been falling from its July high at 112.75 all the way back down again towards the 107.66 low seen last week. And that was the August low. Now we're seeming to hold above there short term, and we'll have to see whether we can actually manage to reach the 200-day simple moving average here in red, which comes in at 108.20, and ideally also rise above it, in which case we could be heading back up again towards the late August high at 109.45. But unless this happens, and as long as we stay below the 200-day simple moving average at 108.20, the odds actually favor for the downside, because after all, we are still in a downward trading channel, as you can see here. And that would mean that if we were to fall through the late August low at 107.66, we would then be heading all the way back down again towards the May low at 106.36. So this would be our next downside target for euro dollar if this further downside momentum were to continue. And it may well do, because last week we saw probably hints of stagflation in the Eurozone economies, because on the one hand, you had growth slowing down, and on the other hand, inflation remaining quite sticky. Whereas in the US, you can clearly see that the US economy is doing quite well. Yes, growth has also slowed down with regards to second quarter, second estimates of GDP. But with the US labor market slowing down, wage growth is also slowing down, and that might actually lead to a less tight labor market there. And that's not something we're seeing at the moment in European markets. And we'll have to see what the impact of this will have on the currency pair. But at the moment, euro dollar actually continues to decline. The euro also looks weaker against the British pound. As you can see here, you've got the euro British pound exchange rate, and that has come off last week's high at 86.10. And yes, downside momentum is on the wane, simply because, probably because of Labour Day today, not many traders trading, volatility and volume being quite low. But over the course of this week, it'll be interesting to see whether we could fall through the 85.45 low from late July, because if we do so, then we most likely will be heading back down again towards the June lows, and these were made between 85.22 and 0.4. So that's what is in store for euro sterling, provided we stay obviously below last week's high at 86.10. Because that high would need to be taken out for us to be heading back up again towards the upper boundaries of the sideways trading range we've been in since June of this year. But as I say, right now, it looks as if further euro weakness might actually push the currency pair down. Moving on to the British pound against the US dollar, as you can see here, the British pound, which makes up 11.9% of the US dollar basket, has also been declining since its July high at 131.42, all the way back down again towards 125.49, the late August low, but it seems to be holding above it at the moment. But here, unless we take out the last reaction high, that is to say last week's high at 127.46, unless that happens, we remain within a downtrend, because we have lower highs and lower lows. And that would mean that if we were to fall through 125.49, the next downside target here in red is the 200-day simple moving average, which would then be basically targeted on a fall below 125.49, and it comes in at 124.21. So that is potentially the next downside target for cable, provided we stay below last week's high, of course, at 127.46. The strong US dollar has obviously had a negative impact on a lot of commodity markets, but an exception is the oil price, because if you look at WTI, the price of oil has risen very sharply over the last few days, and did so especially on Thursday and Friday of last week. taking us now to 9-month highs. As you can see here, we're trading at levels last seen back in November of 2022. And actually, that's more than 9 months highs. We have to see whether this upside momentum is going to continue, but it looks quite likely, in which case we could be heading up again to the mid-November low, which was made at $89.39 and the psychological $90 mark. Now, why has the price of oil in general, not just WTI, but Brent crude oil as well, risen? Well, basically on Thursday, we had the Russian Deputy Prime Minister Alexander Novak say that Russia agreed with other OPEC partners on continuing export cuts. And you also had Saudi Arabia basically hinting that it might extend its voluntary 1 million barrel per day output cut into October. Obviously, all of this has tightened supply, which is why the price of crude oil has risen. But on the demand side, we also had a surprise expansion in Chinese manufacturing activity, as reported by a private survey last week. That has led to more optimism regarding the world's largest importer of oil increasing its demand for oil. And this, together with all the stimulus packages we saw in China over the last week or two, has led to the price of crude oil rising quite sharply, as you can see here, to now around the $86 mark. Now, as I said, I expect further upside to be seen here, perhaps taking us towards the psychological $90 mark. Now, obviously, this will have a detrimental effect on the price of perhaps equities going forward, because this rising oil price will have a negative impact on inflation, which might remain sticky because of that, which in turn may then still have to force perhaps the central banks, especially in the Eurozone, the European Central Bank, to hike its rates and do so in an environment where the Eurozone is actually entering stagflation at the moment. So interesting developments happening over the course of the next few weeks, probably. But right now, the price of crude oil is heading up pretty sharply and quickly, and is likely to continue to head higher. Now, were short-term retracements to be seen, the high seen back in August at $84.39 should act as a pretty good support level. And then below there, we've also got the 21st of August side, $81.73. But further upside likely with regards to the price of crude oil for fundamental and also technical reasons. Now, let's look at another commodity, and this is the gold price. And gold has risen over the last couple of weeks, despite the price of, or despite the US dollar continuing to advance as well. And here what we've seen is a rally from the August low at $1,885 per troy ounce all the way up to last week's high at $1,953 per troy ounce. But right now we're just consolidating here above this tentative support line, which currently can be seen around the 55-day simply moving average at $1,935 to $32. Now, this is the support line and support area for the price of gold. Provided we stay above there, further upside is in store for gold. And once we take out last week's high at $1,953, we could be heading back up again towards the June and July highs between $1,983 and $87. So that is a distinct possibility in case of this uptrend that we're seeing at the moment continuing. If that weren't to be the case, and if we were to fall through the 55-day simple moving average at $1,932 per troy ounce, then we would probably target the 200-day simple moving average here at $1,916. But right now, it looks as if we're just consolidating in an uptrend, and that once that consolidation phase is over, further upside is in store for the price of gold as well. Now, last but not least, I'd like to also mention natural gas prices, and this is US natural gas and its futures price. And as you can see here, we've been grinding higher in a sort of sideways trading zone, but we did reach $3.05 back at the beginning of August and $2.90 last week before coming off again. Now, this rally we've seen recently from the late August lows at around $2.52 was on the back of Chevron workers in Australia and basically LNG workers there, so liquid natural gas, still threatening a strike action over pay and conditions, and Chevron having made them an offer, and that offer having been basically not accepted by the unions in Australia, has led to these tensions and the increase in the price of gas of the last few weeks. And that might keep propping us up. Now, we'll have to see whether the strike actually does take place in the next week or so, or whether Chevron can actually meet more of those conditions asked for by the unions, and that a settlement can be reached. If so, the price of natural gas is likely to come back down again, because after all, the natural gas production in the United States itself has dramatically increased over the course of this year due to fracking, and is likely to continue to offer a lot of supply of gas or natural gas to the world market. Now, here the technical levels to watch out for are, on the one hand, today's intraday low at $2.73, and also the orange line here, the 55-day simple moving average at $2.69. And basically the last reaction low here was made on the 29th of August at $2.63. So basically, provided we stay above $2.63, this recent uptrend remains intact. And if we were to rise above last week's high at $2.90, we would be heading back up again towards the 200-day simple moving average. Here is at $3.02, and also the high seen back in August at $3.05. So let's see what happens with regards to Chevron and the Australian potential strike of energy workers, because that will have a big impact on the price of natural gas going forward. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, the previously called Twitter, and my handle is @AxelR_IG.